market. And I call these guys the traders simply. So guys, let's play a little choose your own adventure because we love games on Fast Money, right? So what is the Fed going to do in just about half an hour's time? And where do stocks and bonds directionally go, let's say 6 months out? Tim.
Fed's going to move 75. Very small chance they move 100. I expect a pretty major rally today. I think both stocks and bonds. And coming into this, I think everyone at the summit knows what's been going on in both of these markets. 10-year, 70 basis points in 3.5 sessions off. Treasuries more oversold even than the stock market. Short end of the curve less so, but also oversold. And I think about the stock market. We all know the math on the last 3 days before we settled down a bit over the last couple. Remember, we've had 3 moves of plus 9% in the S&P off of the intraday lows since January that have still been bear market rallies. And I think we come into this announcement well placed for an equity rally. Don't get carried away. That's what we do.
Guy, what's your adventure?
Well, I mean, that's probably for another show, Melms. But I'm with hashtag smooth on the 75 basis points. I do think that's the right number. I do think the market, the way we've set up here, and if you watch Fast Money, we've been collectively saying we thought we'd get down to 3,700 or so in the S&P. That happened. I think this sets us up for a move back to 4,100. You can do the math. What is that, 8, 9, 10% or whatever is to the upside. But I do think what's going to happen with yields are 2 years is going to stay sticky here. Let's call it 3.3, 3.4, and I think 10-year yields are going to come in down to 3.25, 3.10. I think we're going to see the yield curve invert. I don't think that's going to augur particularly well for the market then going forward. So I think you have this brief run to 4,100. I think you have an overshoot to the downside over the next couple of months on the back of that.
Yeah, and that was what was really unusual, Bonawyn, in terms of the sell-off that we saw earlier this week. We saw just a massive panic selling of assets across the board, presumably into cash. So what do you think the Fed's going to do, and what do you think the outcome will be for bonds and stocks?
You know what? I hope they move. Three's a party. I hope they move 75. That seemingly is what's baked in here. But I think that there's a non-zero probability risk that they only move 50 in an effort to stay consistent with what they've guided towards. And then they will probably have some commentary around making additional moves if so necessary. Yes, we had that CPI reading from last Friday, which I do think puts upward pressure towards that 75 basis point move. But that's not an outright given to me, seemingly that it is to others. And so I do think there is still some risk there. If they only move 50, I think it's very poor for the market. I think essentially what the market says is risk assets are going to continue to be under pressure. I don't think the Fed's moving fast enough to combat inflation. But I don't think the equity market is really driving or dictating what the Fed is going to do. Assuming that they do move 75, I actually think the rally will be a bit more muted than the other two panelists. I think, again, that's what's baked in here. Anything more than that, I think, kind of signals a bit of panic. And I'm really not sure what to make of that. I think 75 is probably your base case. I would allow some room for 50. I think at best we kind of rally, 3-4%. And I think 3,600, 3,500 is very much in play.
Guy, I'm going to jump in because apparently we've lost Melissa Lee for just a couple of minutes. Hi, Guy. How are you, man? Good to see you. Bonawyn just made the point that there is an argument to be made for consistency of messaging. And at the last Fed meeting, the Fed Chief Powell was pretty clear that 75 basis points was off the table. What is the risk that if he goes 75 here now, that the market begins to worry about, boy, this Fed chief is not clear on where he really wants to go, that the messaging consistency is jeopardized?
Yeah, credibility concerns, right? And I'm going to answer your question, but I'll say this. They've also been pretty consistent in saying they're data dependent. And if they are as data dependent as they've said they've been, literally it should probably hike by 2% today if you want to get down to brass tacks. So I hear what you're saying. I heard the question from Steve Leisman. I heard the response from Fed Chair Powell. I was sort of scratching my head. Bonawyn actually spoke about it that night eloquently. I'll say this. I don't think that's created as much a credibility problem as raising just 50 today in light of what we've seen over the last couple months. So I think to Bonawyn's point, if it's only 50, I think the market sells off on the back of that. So, you know, they've painted themselves in this corner, Tyler. As you probably know, I'm no Fed lover by any stretch of the imagination. I am clearly biased, but that would be my response to your question.
And a fine response it is. Tim, let me turn to you. I mean, now you see what the market has done. And the 10-year bond note is what, 3.4 thereabouts. I haven't had my eye on it this morning because I've been doing this. But 3.4. Are we closer to the end of that rising cycle in Treasuries than we are to the beginning of it? And where might that 10-year security top out? Because it has so much influence in the bond market, in the mortgage market, et cetera.
Yeah, and that last segment on mortgage rates and housing was fascinating. I think mortgage rates stay higher, and I think the housing market is under a lot of demand pressure for a couple of years. But the dynamic here also is the Fed is going to certainly indicate the pace in which we're going to move through the cycle. And remember, so far we've been pricing in more inflation, and really the next phase of this and maybe we're there, pricing in recessionary risk. Then it's going to be about earnings revision, and then the next legs are going to be about credit and liquidity. I don't even think we're there yet. But I think about the sequence of where we are and what the market can do here. And I ultimately, again, I think we've had a recalibration of equities across a number of different sectors. And I think ultimately that's the question, the place where investors are starting to assess, a Home Depot, for example, is a company that I could probably own, even in an environment where I think the housing market has pressure, but that the consumer in many cases actually is going to want to fix up that home. So again, I think the Fed has a lot of work ahead of them here. I think the Fed also is going to be balancing the dynamic around the employment picture for America and not trying to scare people. But I think they'd like to see that the joblessness in this country goes higher.
Yeah, the Fed has a lot of explaining to do. Bonawyn, let me turn and ask you a simple, straight question. Do we avoid a recession over the next year, or is it inevitable?
So I'll try to give you a simple, straight answer. I will probably fail in that regard. I do think a recession is more or less inevitable. You can point to corporate balance sheets. You can point to retail balance sheets, consumer balance sheets. I think the erosion of the consumer balance sheet is happening at an accelerating rate, and a rate that far outpaces what we really think is in existence right now, what we really think is the current circumstance. I think we probably have, I don't know, another 6 months or so in terms of that savings glut really falling under pressure. If you look at the readings from today, food and energy are taking an exorbitant amount of wallet away from consumers. And then what is next? That really is the next shoe to drop, and I don't think it's high enough on the radar. At that inflection point, I think recession becomes a real risk in 2023.
We heard earlier today, I want to follow on this conversation, Bonawyn. We heard earlier today from Kyle Bass, who said in my notes were a giant food price hike next year expected. Maybe not even so much here in the United States, but globally, and there may even be food crises around the globe. What is pressuring consumer balance sheets? You mentioned that. Why are they under such pressure now? Is it because inflation is gnawing away at them, or something else?
Well, I think it's twofold. I think it's the inflation story, and you hit that really on the head. Food, energy, and I would also like to mention housing, shelter. That's another major inflationary point. And then you have the situation in terms of credit. You're seeing credit balances grow into a higher interest rate environment. And I think those three things, because that last part is a two-pronged situation. More tapping into credit at higher interest rates, that really starts to eat into wallet. Those pressures, really, I don't see a way around that. I mean, you can point to wage growth, which we've had, but inflation adjusted, it's not keeping pace with inflation. So, you can point to that nominal rate, and yes, it's helpful to an extent, but in terms of real spending power and savings power and investing power, it's not getting it done.
This is a lot of fun for me because I feel like I'm in the Warriors-Celtics. I'm passing the ball. You guys never drop it. Guy, let me ask you, are you in the recession camp, number one? And number two, if we do get a recession in the next 6 months, in the next year, compare it with the grinding recession that we had 11, 12 years ago, 2008, 9, 7, 8, 9, really, where the financial system was at risk of collapsing. Does the next recession look anywhere near as dire as that one did?
Well, I hope I won't drop the ball on you because I want to give you another
won't.
assist in your column of statistics. And I'll say this, there are a number of certainties in life. Death, taxes, my jump shot from 20 feet in, and the fact that I'm not smart enough nor humorless enough to be an economist. So the recession thing I can't really answer. I'll say this, whether we're in one or not statistically, I think for 30, 35 million people in this country, we've been in one for the last 18 or so months. So I think whether we label it or not, it really doesn't help those folks. I'll say this as well. I don't think we're anywhere near where we were 08, 09 when the system was in jeopardy. I think what you're seeing now is just a recalibration on the fact that yields are going higher. Finally, on the back, the inflation numbers are such that they require them to go higher. And this, to me, is just a market sort of saying, all right, what's the right multiple in this environment? To Bonawyn's point quickly, real wage growth in this country is problematic because it's not nearly keeping up with inflation. That's a problem. Interest rates now in terms of where people are paying on their credit cards, we're talking about credit card debt now approaching $1 trillion. That's a problem as well. But 08, 09, I don't think we're anywhere close to that.
Tim, why don't you jump into this conversation and give me your view of that. Compare the possibility of a recession over the next 6 to 9 months with what we went through 12 or 13 years ago and the systemic risk that was faced then.
Well, first of all, I don't see how Guy gets anywhere near the paint to be taking a 20-foot inside jumper. So, just be careful about that. I think, Guy, you're going to have to stay on the perimeter. I think about the potential of this recession. I'm just going to point to a bigger, longer-term perspective. I think people know we didn't just kind of push through, but I think we've decidedly broken through a 40-year down channel in terms of rates. And why is that? And I think, or what were the reasons that brought rates significantly lower in this 40-year cycle? If you think about where we were back in the early to mid 80s when we began this, and it was really Volcker squashing inflation, squashing it both in terms of monetary policy, maybe a little impact on fiscal, but monetary policy and also the psyche of inflation. And that was why it was going big and going hard and going aggressively. The other part of what helped bring rates down was globalization. And we were at the onset of a really exciting moment in the world's history. And I think we've absolutely closed the door on globalization. We've slammed it shut. It's very inflationary. And I think, look, equity markets aren't going to go a lot higher until rates have found some place to peak. But you asked me about what the economy is going to do in this environment. I think the consumer's in a much better place. I think corporate America, first of all, we've transferred the debt in this country from the private sector to the public sector. And it's a global issue. And I think right now, if you look at the dollar, it's telling a tale of where the U.S. is still in a position right now. And look at the collapse of Bitcoin and crypto. And I'm not saying that that's forever. And in fact, I'm a believer ultimately in what's going on there. But we still have a dynamic where our monetary system and our capital markets are the world's biggest and most reliable and safe havens. So I think the corporate sector is okay. I think at some point we are going to have credit issues. But I don't see this as a place where this recession has to be anything close to the global financial crisis of 2008 and 9. I want to see the central bank and I want to see the Fed move aggressively. I want Volcker style. I want 1% today. I want 1% in July. We've priced in Fed funds to 3.60 at the end of the year. Why not get it up over 4.25? Why not raise interest rates after today, 300 basis points between now and the end of the year? That to me is how we have a very severe, but I think a shorter duration recession.
That's a really interesting point, and you anticipated what I was going to ask Bonawyn by way of closure here. If we know, or not know, but if we suspect that the Fed fund rate needs to go to 3 or 3+, why not just do it now, or do it fast, or do it, as Tim says, a point today, a point in July, a point in September, and then you're there?
Well, a couple of reasons. One, we've all been discussing the CPI reading, and quite frankly, that's really not what the Fed is looking at. They're looking at PCE, which really doesn't include food and energy, which are the things that at least in the May reading, were leading to the upward pressure. The second is cadence. And while they've been far behind, and while perhaps they've been wrong, and we can be as critical as we want to be, ultimately, we're all relying on this entity to get this right, to re-steer the economy towards a proper glide path. And so over-hiking, we need to see how markets, particularly the credit market, I think the Fed cares a lot more about the credit market than the equity market. How is that market, how are the options and derivatives on those markets going to create additional volatility? Because I'll tell you what's the only thing that's really worse than what we have right now, Tyler, is adding additional volatility, exacerbating the volatility that we've already experienced. That's what the Fed is trying to avoid. And I think that is probably the use case against over-tightening too quickly without giving themselves some time to absorb, read, and digest data in between those moves.
Gentlemen, Steph, Clay, Draymond, I thank you all. Fantastic stuff. We appreciate it.